Welcome to Investify, where we dive deep into the world of finance, bringing you expert insights and analysis on market trends and predictions. Today, we're talking about a name that resonates with uncanny foresight in the financial world: Michael Burry. You might remember him as the visionary hedge fund manager who predicted the 2008 housing market crash. Well, Burry is back in the headlines, and this time, he's sounding the alarm on a financial crisis he believes could dwarf the one from 2008. In a revealing interview with Business Insider, Burry shared his insights, drawing from a deep well of financial acumen and historical patterns. And if history has taught us anything, it's that when Burry speaks, it's wise to listen. So, what's got Burry so concerned this time? He's looking at the economic turmoil that's been unfolding since the dawn of 2022. The stock market has been on a roller coaster ride, and not the fun kind. We've seen significant downturns, and these aren't just blips on the radar. They're part of a larger, more worrying trend that could signal rough seas ahead for the global economy. But let's not just take Burry's word for it. Let's examine the evidence. Burry's predictions have a track record of being eerily accurate. Remember the 2008 financial crisis, also known as the Great Recession? That wasn't just a small hiccup, it was a seismic event that reshaped the global financial landscape. And Burry saw it coming. His analysis wasn't just a lucky guess. It was grounded in rigorous study and an understanding of economic indicators that many others missed. Now, let's pause for a moment and consider the words of another financial heavyweight, investor Robert Kiyosaki. He famously said that while a financial crisis can be a nightmare for the average person, it can also be a golden opportunity for the savvy investor. This perspective offers a glimmer of hope amidst the gloom. It suggests that even in the darkest economic times, there are ways to not just survive, but thrive. As we delve further into the world of financial wizardry, let's turn our attention to a global event that reshaped economies and individual fortunes alike: the COVID-19 pandemic. This unprecedented crisis left no stone unturned in the financial landscape, affecting everything from global markets to personal wealth. During this time, we witnessed a dramatic shift in the hierarchy of the world's wealthiest, with Elon Musk leapfrogging Amazon's Jeff Bezos to become the richest person on Earth. This seismic shift in wealth underscores the dynamic and often unpredictable nature of the investment world, especially in times of global upheaval. Now, let's zoom in on the man of the hour, Michael Burry. His journey from medical practice to the pinnacle of hedge fund management is nothing short of remarkable. Burry, a doctor by training, made a dramatic career switch, venturing into the complex world of finance. His focus? Investing in distressed companies. These are firms that many might overlook, but for Burry, they represented untapped potential and value. Burry's astute investment strategies were not just confined to thriving markets. He also navigated tumultuous times with a keen eye. He was acutely aware of the dot-com bubble's burst and the economic repercussions of the 9/11 attacks. These events shaped his investment decisions and his approach to risk management. His ability to foresee market trends led him to found Scion Capital, which, under his leadership, grew to manage an impressive $600 million in assets. But what really sets Burry apart is his unique investment philosophy. His strategy of shorting the market, especially his analysis of subprime mortgages, was unconventional and bold. Burry's predictions were met with skepticism, and not all of his clients were on board with these risky moves. However, his foresight proved to be spot on, and those who trusted in his vision reaped significant rewards. In today's digital age, Burry's influence extends beyond the boardroom and into the realm of social media. His followers hang on to his every word, seeking insights and tips on investment strategies. Interestingly, Burry has been known to delete his tweets, adding an air of mystery to his predictions. These deleted tweets, often centered around market forecasts, have become a topic of analysis and speculation among his followers and the broader investment community. Speaking of engagement, I have a question for you, our viewers. What's your take on Burry's approach to investing? Do you agree with his methods, or do you have a different perspective? Share your thoughts in the comment section below. And remember, if you're finding this content insightful, don't forget to subscribe to Investify for more in-depth financial analyses. Navigating the choppy waters of economic downturns requires a strategic approach, and diversifying your investment portfolio is one of the key tactics to weather financial storms. This method involves spreading your investments across various asset classes, such as stocks, bonds, real estate, and even cash. The goal is to minimize risk by ensuring that your investment eggs aren't all in one basket. This strategy has become increasingly relevant, especially when we draw parallels between the current market trends and the 2008 recession. The lessons learned from the past can be invaluable in crafting a resilient investment plan for the future. However, as we look at the factors leading to a potential market correction, a few key issues stand out. High debt levels, overinflated asset prices, and a sense of complacency among investors have set the stage for what could be a significant market adjustment. This scenario mirrors the economic indicators of December 2007, just before the onset of the Great Recession, offering a stark reminder of the importance of being vigilant and prepared. On a global scale, countries are employing various strategies to combat currency devaluation. These measures range from intervening in the foreign exchange market, to selling dollars and buying their own currency, to allowing their currencies to float more freely. Additionally, some nations are raising interest rates to make their currencies more attractive to investors. These efforts are echoed by leading economists, such as Greg Jensen of Bridgewater Associates, who lend support to the notion of an impending market correction. Now, let's turn our focus to a relatively new player in the financial arena, the cryptocurrency market. The crypto market has experienced its share of turbulence, marked by a significant decline in prices. This downturn was triggered by a perfect storm of global events, including the aftermath of the COVID-19 pandemic, soaring inflation rates, geopolitical tensions such as the Russia-Ukraine war, and various supply chain issues. These factors led to a decrease in demand for cryptocurrencies, resulting in a steep drop in prices. What's more, the crash was exacerbated by investors who had heavily banked on crypto for quick profits, leading to a domino effect of selling off holdings and further price declines. The crypto market's volatility highlights the intricate interplay between global events and investment trends. As we continue to observe these market dynamics, it's crucial to understand the broader implications of these shifts, not just for crypto investors, but for the entire financial ecosystem. Understanding market crashes and bubbles is crucial for any investor, novice or seasoned. A market crash is essentially a sudden, significant drop in asset prices, often triggered by a collective panic among investors. This phenomenon can have far-reaching implications, not just for the stock market, but for the entire economy. It can lead to reduced consumer and business spending, closures of businesses, and even widespread job losses. Similarly, the bursting of financial bubbles, which are often characterized by inflated asset prices, can wreak havoc on the economy. These bubbles, when they burst, cause asset prices to plummet, leading to economic distress that affects investors and non-investors alike. Now let's turn our attention to a fascinating aspect of Michael Burry's investment strategy, his focus on water. Burry, always ahead of the curve, has identified water as a critical yet undervalued resource. Recognizing its potential, he's treating water as a newly tradable commodity. This move is not just about financial gain. It's a nod to the increasing importance of sustainable resources in the global economy. We hope this discussion has been enlightening and thought-provoking. If you've enjoyed this video and found it informative, don't forget to like and subscribe to Investify for more in-depth analysis and expert insights into the world of finance. We're always keen to hear from you, so feel free to share your thoughts and opinions in the comment section below. And for more financial insights, be sure to watch our latest video. Stay informed, stay curious, and keep investing wisely. Until next time, this is Investify, signing off.